Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're gonna rip through Twitter, see what people are talking about on social media. I'm gonna give my financial opinions. More than likely, it's gonna be wealth related, commodity related, or financial market related. And those are the ones I really like to focus on because that's what the channel is, and that's what my interests are in. So let's dive in here, see what's going on. Again, if you want to follow me at finding_finance, and I've got finding-value.com if you want to join our community. So, wow, what a jobs report. Just in, the US economy added 336,000 jobs in September. That's another strong month of hiring that blows away the 170,000 forecast. Unemployment rate is 3.8%, same as August. Wage growth 4.2% year over year, above the 3.7% inflation. Yeah, right. 3.7% inflation. Sure. Okay. I don't know where they shop, but okay. Um, this is one of the reasons that we're seeing a big bounce in the markets. I think we saw off this report a big move in yields. Uh, so looking at yields here, we had a big move in yields to the upside. That could be some of it, but it's not sticking. Makes me think that we could see some lower yields out of this thing. Almost like, I don't know, guys. I don't even believe the numbers half the time anymore. It seems like they just revise it lower, and it's giving them an excuse to increase interest rates further. Why? Because they don't have control of the bond market. I think that's what's I think that's what's occurring to some degree. Now, nothing goes up in a straight line. So I don't think yields are just going to go up in a straight line forever. Generally, what they do is they break out. Then maybe we get a pullback. Maybe we pull back to the 4.4% range. Maybe it relaxes. It gets everybody on one side, and then when everyone's on one side, they swap and they switch to the other side. So I think that's definitely possible. So that's the news. That's what is causing, I think, a lot of this buying mania. And uh, maybe rates stay higher for longer. I think they're going to have to because they've got to issue a lot of bonds, a lot of debt. That is a lot of supply with not as much demand to match that supply, I think. Um, this is another guy talking about this TLT longs right now. Why did Uzumpic do this? A massive move off that to the upside, where if you're long bonds, you're getting absolutely crushed. We can pull up TLT. There it is going lower today, but the momentum is coming back to the upside. I don't see a clear bottom on this yet, guys. And I know people are trying to time this market. They're trying to time it where they catch a bottom in yields and they think there's going to be this oh so glorious crash. All I'm going to say is I don't see a crash falling in nominal terms. And TLT works in the nominal term game. So what does that mean? Nominal means that we can see a crash of purchasing power, but it's going to come through the crash of the value of the currency. Bonds may not experience that big move to the upside that some people are thinking for a long term, for a longer term basis, because they're just going to print their way out of it. They have to. There is going to be at some point. I agree that they're going to raise rates and something will break. Something will happen. I don't know what that something is. The economy will be pretty strong because we still have a housing market that's somewhat put together, and that could deteriorate a little bit further to the downside. So we could see weakness at some point. But what's their response going to be? They are so screwed. Um, when they get into that scenario, no, let's say this turns up a little bit, they're just going to turn around and do quantitative easing. They're going to control the bond price. They're going to print money, and then they're going to launch commodities to the moon. And it could launch other things too. That's what I mean by nominally getting, nominally it's going to go up, but purchasing power wise is where they're going to suck that out of the currency. So bonds, they're going to work on a nominal basis, I think. But the problem is you're going to get smoked in real terms, not nominal. So I don't think, I don't know why anybody would want to hold long duration bonds for any length of period of time, for a long period of time. I think that we've peaked. That's what this peak here is, and I think we've got. I think we're going to go lower with time, and I think the real estate market is pushing us into a bond crisis where money comes into the system, interest rates are forced higher from the inflation that's coming into the system, and then it's triggering other events as it goes up. These guys do not have total control over the market, and the market is going to overwhelm them. With their issuances of bonds in perpetuity, however you say that word, guys, you know what I'm trying to say, forever, um, it's going to put a lot of pressure on yields to go higher and bonds to go lower. That is the game we're playing here now. It says the yield on the 30-year U.S. Treasury is over 5% for the first time since 2009. At 4.85, the 10-year will soon follow, rising above 5% for the first time since 2007. Yields won't stop rising at 5%, 6%, and 7% handles will likely follow in 2024, resulting in a financial crisis. Yeah, that's very much the case. But the question is, what is the Fed going to do when they respond to the financial crisis? Um, the problem with this is you can't have the market go down for a sustained period of time because their revenues are going to get wiped out. If you wipe out their revenues, and even if they create demand for bonds, and even if bonds were to come down to some degree, maybe not all the way down to like 0%, but let's say they come down to, I don't know, like a 4% from 7, you're still screwed because their tax revenues decline at the same time that their interest rates remain high and their interest payments outpace their tax revenues. So I don't know how they get out of this, guys. Like I think they're basically done. And the way that you want to position right now, in my opinion, is precious metals, gold, silver, platinum, physical stuff, and then go buy a bunch of hard assets and buy physical things that you need in real life. I mean, that's kind of the way that I view it. Even if we get this pullback and interest rates were to go down, I would even think about taking out loans or something that you need to do on your house or something like that, and then let the inflation just rip it apart. That's me. Again, that has some not advice. That is just me talking aloud and looking at this. Peter says, time to update those Permian M&A bingo cards. Deals, deals, deals. Who's next on the takeover list? Market seems to think Fang or Permian Resources. CVX, the logical buyer. And these guys they're accumulating assets. Fang bought out QEP. I was in QEP when they bought them out. And then PR is another one, Permian Resources, which I'm familiar with. They've done a couple of acquisitions. These guys are going to start beefing up their portfolios, and I like these companies. But yeah, more mergers are going to come. Get ready for the mergers. And I think ExxonMobil's buying out Pioneer for a pretty big deal here. So consolidation coming. Here's some more news. According to Gas Buddy demand data, gasoline demand data much stronger than EAI or EIA is showing. You got strong gas demand. Sign. So here's William Middlecoop. Money printers fleeing towards gold. Source monthly gold compass. So central bank gold purchases at record highs in 2022. They know what's coming. And you know what I'm going to do? I'm going to do the same thing as these central banks. I'm going to start go buy precious metals and protect myself from these people who are buying precious metals, the ones that are creating all this money in the system. They know they're screwed. So they're going to start buying like mad. Now, guess what, guys? The supply of precious metals is declining. We are going to have, in my opinion, very large demand. Uh, in line with very weak supply. You know what prices do when that occurs? Higher, higher, higher. There are only a few periods since 1987 when Treasury bonds were this oversold. Each has been a great opportunity to buy bonds. Now, this is what I'm talking about, everyone getting on one side, positioned on one side. This does look like a shoulder, head, shoulder, and maybe it comes back up to the top level from some sort of scare in the market, a slowdown in the market. That very well could be the case, but I'm not going to touch bonds. Could see a slowdown. I'm going to use it to accumulate more hard assets, more assets that I think will do well in the longer term. So a lot of people will say this is a cyclical type move. A cyclical move is a shorter term move in a time frame. The secular move, which is a long, big picture view, 30 years, 10-year big move, that big move is going to be an uptrend in inflation, interest rates, and hard asset pricing. So yes, we could have a pullback in this hard asset pricing in the short term, but on the long term, I think it's going to be just a wonderful place to be for commodities and hard assets. What he's basically saying, if we were to visualize this, which I agree with, I do think we're going to get a pullback at some point, is we're probably going to peak out at some point. I don't know when that is, just from how over how many people are just shorting bonds at the moment. We could pull back to some degree back here. That is where I think we'll turn and work our way on higher. So there could be, and I don't know with certainty, but there could be a scare in the market. We are seeing bear steepeners happen. What that means is that the long end of the curve is steepening in relationship to the short end of the curve. And this could uninvert to some extent. And sometimes, I'm not saying every time, but a lot of the times when that uninverts, we could see a slowdown or potential problem in the market. When that problem occurs, or if that problem occurs, what is the response of the treasury, the Federal Reserve going to be? So if we come on down and let's say we get a problem and it comes way down, they're going to print money. They're going to re-inflate everything to keep their system alive, and they're going to have to let rates go until something happens in this. Uh, is this going to be one smooth ride where we stay up here for a while and consolidate for a good period of time for the housing market to catch up? Or are rates going to push the housing market and everything? Maybe there's other things in the market that potentially could go bust. And do we cycle back down before we come back up? And then the housing market pushes us back into that upper inflation thing and QE and whatever else they do. And that's what I don't know. I don't know if we're going to stay up here for a while or if we're going to cycle back down and cycle back up throughout this bull market. Both are definite possibilities. Seriously though, why is this? Is this how we beat climate change? This looks like to me a flower that has no water. So if we feed it some water, maybe it'll work back up. That trigger pressure up again. I don't know. Coming down, OPEC raises medium and long-term oil demand forecasts in forthcoming World Oil Outlook report. So there is some forecasts out in the future with increased oil demand. No way, no way. I would have never thought that. We know that. We know there's a lot of demand out there, and that if the supply does not keep up with the debt in the system, what that means is that your GDP is not going to be able to pay off your debt. That's going to be inflationary, and that is what I'm positioning for. That's kind of my paradigm. That's the companies I'm looking at. I'm looking at it from that paradigm saying, well, who's going to be the big benefactors of it? In my opinion, I think energy is going to be one massive investing opportunity, just massive, because that's what's going to pull us out of a debt crisis. And that's where I think that's the possibility of pulling us out of a debt crisis. And that's where a lot of money is going to be spent and allocated to try to get us out of it. And there's obviously a lot of tertiary investments that you can make that are going to do very well to pull us out of it. It could be aluminum, steel, iron ore, the things that move that around, like shipping, et cetera, et cetera. So We got Tavi here. I had him on. Tavi's a pretty cool guy. I think he's got a lot of stuff nailed down right. This is a very important reversal in gold and silver now rallying after the strong jobs report. Pay close attention to securities that rally on bad news, particularly from historically oversold levels. Furthermore, it's worth noting that commodity trading advisors CAs continue to hold extremely bearish positions on gold. This is the ideal setup for metals to substantially rise from here. I completely agree with him. I think that we are vastly uh, so. So here's the thing, guys. All right, this is how you make money, in my opinion. When all the sentiment goes to the negative side, that's when you load up. Load up when no one's looking. When everyone's looking at Nvidia or Tesla or whatever the heck they're looking at, and you want to come back when no one's looking. You say, you know what? I'm going to buy a whole bunch here. I bought a bunch in 2018 in silver. We're talking, they had deals on American Silver Eagles, dollar over spot, $1.50 over spot, $1.99, somewhere in that range. When they had their deals, you could buy them. And you know what the price of silver was 2018 during some of those time frames? I can remember it being like $14, $15, and you could buy after, with the premium, 16, 15.50, 16.35, like all through there, depending on what you're buying. If it's American Eagles, if it's regular or regular bars and regular rounds, they would throw these stupid things. And even before that, there were some deals that they were throwing out where you could buy like the premiums were like 19 cents over spot, 29 cents over spot. There was some really good deals in the early days, back in the 13s, 14s and stuff, super cheap deals that you could get. I think right here looks pretty good for gold, silver, and platinum. That's what you got there. Adam Rosenswag entertains the idea of $300 uranium price spike. Really? Wonder who else was thinking that we could spike in uranium. I even think 300 could be on the low side. I think oil could get up to 300 or greater in this big move. So again, I'm going to remain bullish, and a lot of people are going to say, "Well, what's the economy going to do?" Guys, it's not about the economy. You guys are looking at the wrong thing. This is all about the value of the dollar and then the response to the slowdown that the central banks are going to respond to. They're going to save the bond market, guys. I hate to tell you that, and it's going to be at the expense of the currency. The currency and the inflation from that currency debasement is going to push uranium and all these other energy, I'll call it energy minerals, the moon. So oil, nat gas, uranium, those are your first inflation input costs. That's where the money kind of flows through first. They're highly inflation sensitive. Platinum's another one that's highly inflation sensitive. So we're gonna find out what the response is going to be when you get a market slowdown at whatever point that is. Wake up, he says, in case no one has noticed, the U.S. national debt has risen by $444 billion in the past 2 weeks. At that pace, the U.S. would be adding 11 trillion per year to the national debt. Something is clearly going wrong. A sovereign debt and U.S. dollar crisis can't be too far away. And that is where I'm talking about the dollar debasement. So the pressure is going to start in debt. That's your bonds. That's your TLT. The pressure is mounting in the bond price coming down like that. People are selling off. The bond market, if you look at like TNX, this is your yields. This is a problem because TNX is the underlying structure of how everything is priced in the market. You can't have this be bouncing all over the place, unstable. Because if it is, it means that your pricing mechanism of all your other assets is stable. Now, if you're issuing far too many bonds and you have a debt crisis, this is just going to continue to go up. So what they're going to try to do is they're going to try to stabilize the debt market because everything is priced off this debt market. So if they go to stabilize the debt market, what they're doing is they're transferring the pressure in the debt market into the currency market. So the pressure is going to be aimed at the currency, the dollar. and it's going to lose a lot of value. When they go and they pressure that with QE or something where they try to stabilize the debt market, you're going to see pricing on uranium and all these other assets that are input costs to everything else rocket to the upside. And that's what we've seen in history. That's where the pressure. Then, if the pressure basically focuses on the commodities and inflation, the next big boy to run is going to be GOLD. This is going to rocket like no other. Same with silver. Silver, gold, and platinum are going to be the ones where the pressure ultimately ends up because people are going to start to get afraid of the currency. That is how this whole thing plays out quickly. It says, you have to admit the irony is quite funny. EV battery factory will require so much energy, it needs a coal plant to power it. Gotta love it, guys. Gotta love it. Here's another thing. A lot of people talk about news. Should we trade this off the news or whatever? Let me just show you something here. Oil nosedives as JP Morgan warns that demand destruction has begun. Then you look a couple days before that, a week or two before it, Brent oil prices could reach 150 per barrel, says JP Morgan. I understand that it could be at different time frames, but be careful on the news. I don't read any of these news articles where I make decisions based off of it. That's where I develop the technical analysis and how I incorporated that into my ideas and the strategies that I deploy. It has nothing to do with news because the news is going to tell you one thing and then swap you to another. You want my honest opinion, guys? I think that they manipulated the price of oil downward before this jobs report release. That could potentially be something that they did. I don't know for a fact, but they could be doing things like that. We're back to 82, which is a pretty strong support level. And it seems like they try to manipulate these things around government releases, around whatever. Gold as well is another one where they don't want it to run after they release information, so they push it down. And JP Morgan and a lot of these guys, they're actively open with themselves. They're like almost bragging that they're like, yeah, we pushed down silver $2. We did this. It's almost like they're bragging about it. So I think eventually this is going to break much higher into a land far, far, far away. This is timing the uranium market. That's what it looks like, even though the guy is timing it pretty well. Like he hasn't lost yet, but pretty crazy. This guy's obviously played this level quite a bit. Yep, this is me talking about some things if you guys need any help, service. Gold and silver is the counterweight versus the defended global fiat monetary system, and it is dying. So it should be obvious not to expect this bull to be easy. Expect it to be hard, very hard, and do not get disappointed, i.e. emotional. Understand it. That mindset is keep that bullish mindset on where you think that we're going to get inflation in the end. We're going to get some scares along the way, guys. It's not going to be easy. It's going to be hard earned. And we haven't had the scare yet, but it's going to come. And then they're going to print money. Then we're off to the races. Okay. The mining industry is running out of miners. This is a bunch of information about number of mining engineering graduates. Mining's not attractive to young talent. We just don't have a lot of people going into it. This is setting up for a supply side shock at the same time that we're going to get a demand side shock, both at the same time. I've been posting big evidence for many months that something big is brewing for precious metals. Very big picture. We've seen it 70s bull, the 2000s bull, and now you're in the final third bull market. Gold, 10,000 to 15,000 is next. Opportunity of a lifetime still. We are at a very good spot to be looking at precious metals. The sentiment is very negative at this time. The third bull move, which will kill the present global monetary system. And I hate to say it, guys, but this could be something where you almost have to be in it to preserve your wealth. So again, big third leg's coming. Get ready for it. And it will hopefully, well, not hopefully, but I think it will start soon. Another historical macro chart, some key observations, and this is dealing with the very steep yield curve inversions. Reversions do not always imply a recession or even an imminent one. So we can see that we had some 1980, 1974. A lot of these, if you look at history, are coupled with real estate cycles or business cycles. The real estate cycle coincided with 69, 74, 80. And the uninversion were those ended in recessions, these green recession areas. Those were housing market crashes. A lot of them. Not all of them, but a lot of them. 1990 was another one. This is a housing market crash in 1990. So that was also an overbuilt scenario. Commodities were expensive in 74. They were expensive in 80. They were expensive in 1990. They were expensive in 2006 and onward. So these also coincide with big commodity bull markets when it inverts like this. We are also very much inverted, but that doesn't mean that we can't invert further. Much like the 1974, you get this kind of double bottom, you get this multiple move up and down in 1980. We very well could do that. And we don't know what the necessary future is. But if this curve uninverts, that is generally when we could potentially see a problem or a slowdown in market. That's the uninversion here. Sorry for having that go off the screen a little bit. So I think the commodity bull market's alive and well. Seeing that with ratio, the TR, this one here, this ratio here is still looking very good for a move higher. We have a long valuation runway ahead of us where commodities could vastly outperform. What market conditions is this going to occur under? Inflationary market conditions, higher interest rates, and again, we could see a pullback or a sideways move or something in the short term. It's very possible. But I think over the long run, this is going to go all the way back up. Yeah, a gigantic rotation of money going to occur where money's going to flow away from financial assets, hard commodity assets. So that's what I'm going to say now. That's where I'm going to leave it, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you'd like, and join our community. That's where I go over individual companies, how to take advantage of all this. I also like and love physical precious metals. I think that's a really good spot to be. And there are strategies that you can use to increase your ounces time ratios. So that's what I've got for today, guys. We'll catch you next time. Finding value.